Hello everyone, welcome to AleaSoft webinar. My name is Alejandro Delgado, Technical Director of AleaSoft and Associate Partner of Alea Green, and thank you for joining us today to the webinar with the topic Prospects for Energy Markets in Europe, Methodology for Long-Term Forecasting, Keys to the Energy Transition and Renewable Energy Projects Financing. Our speaker today will be Oriol Salto, Data Analysis and Modeling Director of AleaSoft and Associate Partner at Alea Green, that we talk about such interesting topics. If you have any questions at any time during the webinar, please use the Q&A menu and we will answer them after the presentations. And now, I hope you enjoy the webinar. Oriol, please check your slides.
Thank you, Alejandro. Good morning, everybody. Let me... Okay, here it is. Let me share my slides. Okay, so good morning, everybody. Thank you, Alejandro. As all, oops, sorry, that's not the first slide. Let me go. Okay, now, right. So again, good morning, everybody. Thank you, Alejandro. Today we'll be making our monthly webinar. As usual, we will be reviewing the state and the status of the energy markets and the energy demand and variables in the European countries. And in the second part, we will be touching some topics related to the energy sector. We'll be talking about project financing, about PPAs, about the long-term forecasting, and we will be analyzing some aspects, some topics on some items on the new draft for the updated version of the National Energy and Climate Plan in Spain. They may look kind of odd topics, not very related, but they will show us a general view on how the energy sector is right now. And it will be an important source of questions, probably questions that we can answer afterwards. And also, I now take the chance to invite you to the Spanish version of this webinar that we will be doing in a couple of hours at noon, at 12 o'clock. You still have time to request an invitation if you have the chance. In the Spanish version of this webinar, we will have also collaboration participation from renewable energy developer company, banks, and asset management companies. So we will be a very interesting discussion about the state of the energy sector, the state of the financing of renewable energy. So just if you have the chance, you still have time to request an invitation in our website for the Spanish version of this webinar. But anyway, we are going to do the full version also in English. So let's go ahead. I will start as always with a brief introduction about AleaSoft, the company and the services that we are offering, in case you don't know us. In AleaSoft, we offer forecasting services for the energy sector. We are covering all the energy markets in Europe. We are also start covering some energy markets in South America, also covering some markets in North America. We are expanding in these two continents. And our goal is to cover all the energy markets at the global level. So also we will try to expand through the Asian markets. This year, we are celebrating our 24th anniversary of the company. And our goal by the end of the year is to fully cover the 35 energy markets in Europe. We will be covering demand and prices and renewable energy production and also conventional production in 35 markets, all of them at short-term, mid-term, and long-term. Because we provide basically forecasting for any variable that can be interesting for the energy sector. As I mentioned, our forecasting goes from the short term, that it's the day ahead or hours or minutes ahead, up to the long term. So long-term reports that can cover up to 3 decades. We forecast obviously demand and price of gas and electricity markets, but and not also spot markets or day-ahead markets, but we also cover futures markets and also ancillary services like intraday auctions, secondary reserve, imbalances, constraints, etc. We also make forecasting of renewable productions and any variable that can be interesting, weather conditions, socioeconomic indexes, CO2 prices, fuel prices, Brent oil or coal prices. And we not only make, let's say, deterministic forecasting, we also make simulations. So we can make hourly price simulations up to several years in the horizon. So very interesting also for risk management, for financing modeling. The methodology that we use for forecasting is our own methodology. It's a methodology that we developed ourselves specifically for forecasting in the energy sector. The three main points that we always like to stress about this methodology is that it is a completely scientifically based methodology. This characteristic gives consistent results, coherent results that keep consistency from time to time. This helped to build a trust relation with our clients along the 24 years of history of our company. And these 24 years of experience is basically what gives us one of the main points in our strong points in our methodology. We started with the Iberian electricity market, now covering all the energy markets in Europe. So let's start reviewing the status of the energy markets. I always start with the oil prices. These are the Brent oil prices, daily prices for the last year and a half. So basically, if you remember in our last webinar, we were basically saying that we were, since the beginning of the year or since late December, we were basically in a stable. I mean, it's not completely stable because it has a lot of volatility, but there's no clear trend in prices. And we were also mentioning that it is still true that there's a lot of uncertainty. So there's a lot of uncertainty on the production side and also on the demand side. And right now there's neither the demand side nor the supply side is winning. So we have this strange balance where that are keeping the prices very, very flat in trend, but again, with a lot of uncertainty. So on one side, we have some analysis that basically tells that the increase in the demand that it was expected for the coming years. So how the global economy is still recovering from the COVID crisis. So it's going to be much lower than expected. So this is basically and some analysis say that there will be no issues with the supply up to 2028. So basically this is pressuring prices to go down. So no increase in the demand, no problems in the supply side. So basically favoring lower prices. And on the other side, as the cost of money is increasing, this makes production or finding new oil sources. It's making it more expensive. So basically, we are consuming the storage that we have. So at some point, it looks like prices could start growing due to the to less storage and more costly production. So there are these two phases of the situation, and looking at the price evolution right now, neither of them are winning. So again, prices around 90, 80, $70 per barrel, but no clear tendency, no clear trend, and a lot of uncertainty for the coming months. On gas prices, on the other side, since the highest prices that we had in last summer. Basically, the trend is clearly downwards. We reached, before our last webinar, it was 4 weeks ago, we reached the 25 euros per megawatt hour. Those are the levels of May 2021. Since then, prices jumped up to nearly 40 euros megawatt hour, but then they are already down to 26, 25 at some point in the day. So basically returning to this level. It's something like what happened when we reached the 40 euros megawatt hour. We reached that value, then we jumped again above 50. We stayed at the level of 40 for some time, and it's happening something similar with this 25 euros megawatt hour barrier. It make prices can still go down a little bit, but as we will see in the futures market, it looks like this 25 euros megawatt hour could be the equilibrium price at the long term. So probably the expected evolution of the prices are prices fluctuating around these levels, maybe going a little bit lower. But I mean, we are reaching the levels that we had before the crisis, so going much lower looks a little bit difficult, at least in the coming month, for the coming year. Afterwards, maybe they can go even a little bit lower. So we are seeing kind of a stability. If we look at how the storage levels that we have right now, just yesterday we reached the 85%, and we are okay, we are already in the summer, but not even in the middle of the summer. If we look back 1 year ago, we were just at 62%, and you can see how the refilling rate is pretty stable, not as crazy as it was last year, where we were trying to recover from very low levels. So basically, this is what is bringing these stable prices that we are seeing. So no crazy race to increase levels of storage, because they are pretty full. So looking into the winter, it looks pretty quiet situation, but you never know, because gas is very sensible to all the geopolitical situation. So let's see. But if nothing extraordinary happens, we are facing the winter with a pretty good beginning. And in our last webinar, we talked about the first joint gas purchase in the European Union, where the offers reach close to 12 billion cubic meters. The second tender is already in place. They collected nearly 16 billion cubic meters of offers from demand. The supply offers were already finished on Monday, I think, but they didn't publish it still. They still didn't publish the numbers, but probably the supply offers would be more or less at that level. So we could say that it was a successful second tender for joint gas purchase in the European Union. It's being, at least it looks, it's being a used method to provide gas with certain stability, and we don't know the prices, because the prices are then negotiated between the two parts of each contract. But at least it looks like a more stable and competitive prices. And looking at CO2, we are basically following the same situation, always below the barrier of the 100 euros per ton. Basically, the same situation hasn't changed much. No new attempts to break this barrier at the 100 euros. A lot of volatility, prices easily 30% volatility within the week. So no new situation in the CO2 prices. Okay, now about the electricity markets. As always, I will take this opportunity to show you our online data platform. It's a service that we offer to our clients. Is a place where you have all the data for mostly every energy market in Europe, and we are updating and including new data every day. Basically, you have all the data that you need if you are in the energy sector. You are an analyst, a trader, an investor, a journalist, a CEO, a CFO. So any role in the energy sector, what you need is information. Information is power. So the more updated and robust and reliable information that you have, the better your decisions will be. So the convenience of having all the data in one place with one format, always updated and from reliable sources, it's very convenient. So here we are seeing the monthly average for some of the most important electricity markets in Europe. The last full month that we have, it's June, and here you can see the average prices. Basically, quite similar prices from May. Prices a little up following the behavior that we saw in gas prices. So basically, Italy stayed more. It was the higher price. It stayed basically the same, just a decrease of 0.4%. On average, the increase was 10%, and the highest increase was in the Spanish and Portuguese market. That was an increase of 25%. So little upward trend following the little increase in gas prices that we have seen. If we look at the daily average prices for the last weeks, we can see how basically it's the same shape that we saw in gas prices. So gas prices jumped up a little bit again. We saw an increase in electricity prices, and basically a stable around this 100 euros per megawatt hour. You can see this day, this was on July the 2nd, it was Sunday. And if we look at the hourly prices for this day, you can see how prices went down to minus 500 euros per megawatt hour, and it was two markets reached those low prices. There were Netherlands has minus 100, minus 500 for several hours. Also, Germany had this price for 1 hour. So some specific conditions that we find from time to time in these markets. But basically these are kind of exceptional situations. Prices for the rest of the time around this 100 euros megawatt hour. So, and other interesting things, for instance, in the Spanish electricity market, we can see how the electricity demand, that's the hourly electricity demand for the last weeks, you can see how it has a clear upward trend. This is clearly and basically related to the increase in temperatures. We can temperature is also a variable that we have here. See, this is temperatures, and we can plot both together. This is the daily demand in blue and the daily average temperature in red. The electricity demand is very correlated with the temperature, directly correlated with the temperature. So higher temperatures means higher demand. In the current conditions, this summer we are having El Niño phenomenon. El Niño to this part of Europe, it basically brings more heat, more higher temperatures. So last year it was already a very hot summer, and everything points out that this summer it's also going to be very, very hot. So we can expect also very high electricity demand. Also, high temperatures has impact on renewable energy production, because usually in summer we usually have less wind, and also photovoltaic panels are less efficient with high temperatures. So even we have more radiation, we can have more solar radiation, we can have less efficiency on solar panels. So important impacts of temperatures in electricity demand, and also in electricity production, and at the end in electricity prices. Okay, back to our slides. In our website, you can find all the reports that we have analyzing different aspects of the energy sectors. We have, as I mentioned, long-term price forecasting for all the markets. These are the ones that are most demanded, but we are covering basically all the markets. We have reports analyzing PPAs, different aspects of the future of the energy sector, analyzing different drivers on the electricity prices, and also analysis on specific projects or specific locations, analyzing capture prices for a given, or renewable resources for given locations or given existing prices, existing power plants. Now, if we look at what the futures market are telling us, those are basically prices traded today for the energy that will be delivered in the future. So this is the forward curve for the Brent oil. Basically, it is compared to the forward curve that we showed in our last webinar 4 weeks ago. Basically, as we have seen that the spot prices basically didn't change, so basically no change in the forward curve. Long-term prices, equilibrium prices, are still around $65 per barrel. For the futures of the TTF gas, basically at the long term we see basically no changes, but we saw an increase in as the spot prices increased a little bit from 25 to 40 euros more or less. We saw an increase in the futures prices for the next 2 winters, so until the beginning of 2025. So 18% increase in prices for 2023 and 2024, basically pointing us that still we have 2 winters. The 2 next winters, prices will still be higher than those we had at the before the energy crisis. So basically, still the return to the previous levels are still around 2026, 2027, more or less, and those are going to be those prices around 25, as I said, 25 euros megawatt hour, are more or less the long-term prices for gas that the futures are seeing right now. So the situation that we are right now, we can expect a little higher prices for the next 2 winters, and afterwards a return to the previous level is expected on average. As always, the spot prices will be fluctuating a lot, but this is the general trend that the forward curve is telling us right now. And for CO2 prices, this is the forward curve for the CO2 prices. Basically, as the forward curve for the CO2, it's usually very rigid, so it moves altogether the same in all the maturities, in all the horizon. So basically, following the spot prices, exactly compared to the 4 weeks ago increased a little bit. So basically, this 5% increase in all the curve, but basically no dramatic changes in the futures markets. And finally, the power curve, the forward curve for the power markets, for the electricity futures. What we are seeing, these are for this the European market that has longer maturities, a decrease of 11% in just 4 weeks. We are comparing it with 4 weeks ago. In 4 weeks, the long-term prices decreased by 11% in Italy and Germany. Basically no changes in the Spanish forward curve. And for the most liquid markets that are basically Cal24, an increase of 8% in Spain, and then the largest one is in Italy, if I'm not mistaken, 18%, and then around 10% for France and for Germany. I was mentioning the most liquid product, that is Cal24, because these markets are very liquid at the long term. So basically there is no energy to trade at these maturities. So just as a warning, you can see how in just 4 weeks prices for 10 years ahead can change by more than 10%. This is not a reliable price forecasting. So those are futures markets. Those are forward curves. So they are not they are not a good forecast for futures for future prices in the spot markets. And just trying to summarize everything for this first part of the webinar, what are the key elements that we are taking into account when forecasting the electricity markets? So as we have seen, oil prices remain at the same levels, around $70–80 per barrel. No clear trend, a lot of uncertainty on both sides, demand and supply. So we're still not clear which one will win. And in the meanwhile, prices with some volatility, but no clear trend. So basically, we have to wait and see which will be at the end the trend that will be delivering prices for the next month. Gas prices, they reached the 25 euros megawatt hour. They jumped back to 40 euros, but now they are again going down. They are now at 26 euros megawatt hour, so already very close to that floor that we are seeing right now at 25. This basically shaped the evolution of the electricity market prices, as we have seen. So some higher prices in June and July that we were seeing in May and in the first half of June, basically following the same shape. CO2 prices, no changes, still below the 100 euros per ton, and with high volatility associated to that prices. Futures, gas futures increased for 2024. This means that electricity market prices will be at high levels for the next year, next to winters. And right now, it looks very unlikely to have peaks of prices that we had last year. So basically, we are seeing higher prices, but as the situation of the reserve and the joint gas purchase that they are in place, basically show a stable situation. So high prices, that's true. We are not back to the prices that we were used to, but the situation is more stable. So high prices, but there's but peak prices are unlikely, or less unlikely, or less likely, sorry. And at the much longer term, basically the situation hasn't changed. We have the increasing in renewable energy production. Prices will be determined by this production, by the cost of storage and the production of green hydrogen. Hybridization of all these technologies in order to make everything more efficient is going to be key. And all of this is what is telling us where the equilibrium price at the long term is for the electricity markets. Okay, and with this we finish the first part. That's the usual the usual part that we have each month following the energy markets. And now we will be covering some aspects for the energy sector. As I said, they may seem an odd choice of topics, but hopefully they will give you some ideas on questions that you can already put in the Q&A section of this webinar. So hopefully we will have some time to answer them. And as I told you, in the Spanish version of this webinar that we will have at 12 o'clock, we will have an analysis roundtable and answering questions, analyzing all these topics with participation from renewable energy developers, banks, and asset management companies. So very interesting invitations that we have for this webinar. You still have the chance to request an invitation in our website. So financing of renewable energy projects. So basically financing, when financing renewable energy projects, the financing conditions are based on the risks associated with the project. There are a lot of aspects on the risk of guarantees, counterparty risks. But one of the, well, I don't know if it's the main, but it's the one where we are experts. It's the price risk, the market price risk. So depending on how your project will sell the energy, it will have a risk exposure to market prices. So depending on how good you are on assuring, on guaranteeing your incomes, the price that you are going to sell your energy, the better the conditions for the financing will be. So you can be completely exposed to market prices, but this means that within 2 months you can be selling your energy at 700 euros megawatt hour, and within 2 months you can be selling it at 0 or close to 0. So this is a lot of volatility. Electricity market prices are very volatile, and more with this unstable situation that we have and that we had in last year. So let's say there are entities, lenders financing 100% or full merchant projects, but obviously financing conditions are, let's say, a little are worse, because the risk of not being able to pay back your debt are higher in this case. So one of the usual tools to mitigate this price risk are PPAs. PPAs are basically a tool, and they have to be understood like that, like a tool to mitigate the risk associated with the fluctuations in the electricity prices. So some people try to interpret it like, I mean, it's something that we can use trying to beat the market, trying to get a better price than what the market would give us. That's not the idea for any of the sites. So even if you are the producer, or if you are the off-taker, the idea is not trying to beat the market, not trying to get a better price than what the market would give you or would cost you, but just mitigate the risk. So there are several ways where you can define the price in a PPA. There's the option of the fixed price. Then there is, if not, there are some other price structures that usually include a floor and a premium over the market price, or a cap. But basically the idea of the price structure of a PPA is reducing the volatility, even down to just having a one price for the whole period. Okay, so the idea is clearly shown in this graph. Those are the Spanish electricity market hourly prices. As I said, within 1 month you can have 700 euros per megawatt hour of difference in the price. So this is a lot of uncertainty, and uncertainty means risk, and risk means worse financing conditions. So basically, if instead of being exposed to these prices, you can just have a fixed price, this means for the producer that you hedge your position. You have predictable income, predictable revenues, and you can ensure that you can return you have a return on your investment, and you'll be able to pay your debt. On the consumer side, you have predictability, energy cost, usually at more competitive prices that you would have in the market. But again, this is not the idea. The idea is not to beat the market, but to have certainty about the future. With predictable energy cost, you can plan on upgrades, you can plan your investments on improving your facility. So basically, you can be very certain about your future, something that you cannot have if you are exposed to buying your energy directly into the market. So the idea is sign the PPA, set the price, and then forget about it, because you can plan everything already knowing the price without the uncertainty associated with being into the market. And well, the PPA is just one part of your energy selling or your energy buying strategy. The idea is the all energy that you produce or that you consume, you close a part at the long term with PPAs or with or with shorter bilateral contracts. Then at the midterm, you can go to the futures market. You have yearly products, quarterly products, monthly products, weekly products, even daily products. Daily products are more in the short term, where you can always also go to the spot market, to the day-ahead market, to have, because you can have opportunities in the day market. So you should be closing your energy selling or your energy consumption at different steps, always taking the best opportunity in each side. But as more energy as you already have set a price for, being it in a PPA or a future market product, the more certain you are about the future. So, and another topic, long-term power market price forecasting. So what's the idea when we are forecasting prices 30 years ahead? So obviously, when you are forecasting prices for the short term, for the next day, you are taking into account what day of the week it's going to be, how much sun it's going to be, how much wind, what's the temperature, how it will affect the demand, etc. So you are pretty certain about what are the conditions the next day or the next 2 days or even the next week. So you can be quite certain about what will be the conditions at the short term. But when we are talking about 30 years ahead, obviously we have no information basically, or no possible certainty on how windy or how sunny will be a given day into the future, even though we have to set a price for that for that date and for that hour. So what's the strategy? So just to have an idea on how things can change within a decade or within 2 decades or 3 decades, this is the monthly generation mix for the electricity Spanish system. And you can see here almost 2 decades. And you can see that basically within those 20 years, the only thing that remained stable is basically nuclear production that you have here at the very bottom, and this is CHP. CHP, it's been also very stable. Hydro, that it's in blue, it's been also very stable. But this is basically 1/3 of the production. The rest has changed dramatically. So we started even having fuel oil. Then it disappeared. Then we have coal, we had gas, then we had coal again and very few gas. Then coal disappeared completely and we have gas. Wind energy in green has been increasing. Photovoltaics from being basically zero, being up to 20%. So dramatic changes. So everything, all this needs to be taken into account when looking 30 years ahead. So one could think how the market can work, how the electricity market can work with this very different situation. So from a time that we had very few gas, we had very few wind energy, we have a lot of coal. So basically our system was based on coal. How can it change compared to now, where we have no coal, we have no fuel oil, we have basically gas as a backup, wind energy increased a lot, photovoltaics increased by more than 500%. How all this can affect the prices? That's what we are trying to forecast now. Well, if we look at how the prices have evolved since in these last 20 years, well, okay, the scale is a little bit large because we have this peak, but if we forget about the COVID crisis and the recent energy crisis, if we look in October 2010, that's where we made this forecasting in blue. We made this forecasting 10 years ago. And basically we were forecasting, looking at the past, it may look somehow chaotic, but the models basically forecast this rather stable, I would say, market equilibrium for the next 10 years. And looking at how the real prices has evolved, has realized, I mean, the model has been pretty good, understanding how the market equilibrium works. So despite all the changes that we have seen in the electricity mix, how the production of electricity has changed over all these years, the market equilibrium, the price at where the market is an equilibrium, it's rather been maintained, or it's been where our model predicted it to be. Obviously, it fluctuated because we have draft seasons, we have windy seasons, we have gas price crisis. So obviously, all these affect the prices and it fluctuates, but that's the idea. The price fluctuates, but it fluctuates always around a price equilibrium, an equilibrium price. And that's the idea behind our methodology for long-term forecasting. So find what's the price equilibrium, the equilibrium price at what the market is working, and then project it based on the evolution of all the demand, all the variables, demand, renewable production, fuel prices, etc. But there's an equilibrium that it's usually not broken. Obviously, when we are in a COVID crisis, a global pandemic, obviously there's, I would say, less than 1% probability. And if 10 years ago we were trying to forecasting what's the probability of having a global pandemic, I would say less than 1%, but it occurred. Okay, but that's interesting. We still think that the market, the equilibrium price, the market equilibrium price is still there. So if we are in low prices, we expect prices to go up again. And this is what happened. Okay, then we had a gas supply crisis. Prices went up again, went up a lot, but the equilibrium prices is still there. So the expectation is prices to go down again. And we are somehow close to what the equilibrium prices, our models in 2010 said the market equilibrium would be 10 years ahead. It's still pretty there. And if we look at the forward curve from the OMIP futures market, they are basically telling us prices trend is going to go back to this equilibrium, the equilibrium that our models were saying 10 years ago. So when forecasting at the very long term, so what's the best approach? The best approach, we say, it's try to find this equilibrium and then try to estimate how much prices can fluctuate around this equilibrium. So here you can see in green, you can see the confidence band. Confidence band is something that we provide, and it's basically telling us this is the equilibrium And the confidence bands are telling us what's the expected variability, because we know that prices will fluctuate. We are only giving the average price, the equilibrium price at the long term, but prices will always fluctuate, but they will always fluctuate around this equilibrium. So we are providing confidence band to give you an idea of how much they can fluctuate, or what's the probability of the prices going above or below the bands, because those are confidence bands. Those are usually representing a 70% confidence band. This means that 70% of the time the price will be within the bands, but there's a 30% probability of the prices going above or below this confidence band. And it's something that we have seen. At some points, prices go off the bands, but then they return back to the inside this confidence range. And this is what we think that makes more sense when making long-term forecasting. It makes sense, instead of giving you just one forecast, giving you just one price per day or one price per hour, instead of giving you just one forecast, it makes more sense to give you a probabilistic metric. So probabilistic metrics, we think, are the most meaningful outputs when we are doing long-term forecasting, because we know it's impossible to see what month, what day will be windy, will be sunny, will be in a cold spell. So we can only predict what the average probability of having that price is, and then what's the probability of having higher prices or having lower prices. So this is what we provide in our long-term reports. We provide an average price forecasting, the P50. So this is the central forecast. So it's the same probability of having a lower price and then having a higher price around this price. And then we are providing two confidence band, one with a lower probability, one with higher probability. So for low prices, we can provide a 90% confidence band. So there's a 90% probability that for this year, the price will be above this value. And in this way, you can know at any given year in the horizon, what's the probability of having a price higher or lower than a given value. So this is a fundamental input for a financing model. So you can know more or less what's the probability for a given year that I will not be able to pay the debt because prices will be too low, or what's the probability of for me not being able to pay the debt for a given year. But that's year by year. What's maybe more interesting is having this confidence band with ranges of years, because I mean, having 1 year of bad luck and having low prices, it really doesn't mean anything, because your project has a lifespan of 25 years. So what's the probability of the price being low? What's the 90% probability of the price being low for this 5-year range, or for this 10-year range, or for the 30-year range of the whole lifespan of my project? So this is basically telling if I have to pay the debt in 10 years, what's the probability? What's the 90% percentile for the whole year? Sorry, for the whole range. So the average price for the whole range associated with a given probability. And that's the most meaningful data that we can provide. And we think that it's not the usual data that it's provided with long-term forecasting with most of the other providers. They are usually providing alternative scenarios, but we think they are kind of arbitrary, because you have to choose a low gas price, low demand, and choosing alternative scenario, it's also kind of arbitrary. We think it's more useful provide a value and a probability associated to that value. And okay, just as we are talking about our long-term forecast, we do most of our long-term clients or clients for long-term forecasting has quarterly subscriptions. So we fully update all our forecast every 3 months, but we can also provide on-demand forecasting. So at any given point, we can update a given market and provide you with a long-term forecasting within days. So with very few days, you can have an updated long-term forecast for any given market. So, and just we have 10 minutes. Let's see if we can have some time for some questions. Last week, sorry, or the previous week, we have an update, a draft update for the National Energy and Climate Plan for Spain. All the European countries has to provide a draft update within this month, I think, or last month it was, I don't remember. Okay, we will be focusing in Spain, which is the one that we have analyzed more in depth, and there's been a lot of interesting changes. So that's that we will try to highlight some of the most important characteristics that we have seen in this update. So these are the scenarios for the installed capacity. So I would say the largest changes or the largest targets are for solar photovoltaics. So 76 gigawatts expected in 2030. That's 57 of utility scale and 19 from self-consumption. Also wind, 62 gigawatts. That's a lot. Some increase in solar thermoelectric, very little increase in hydro, increase in biogas. The idea is okay. Well, coal has already disappeared. The idea is to keep the same gas, the same combined cycle gas turbine, and then energy storage, 18.5 gigawatts. This is considering batteries and hydro pump. But also we have to take into account that there are 3.5 gigawatts of solar thermoelectric storage. Compared to the previous plan, what are the main updates regarding installed capacity? So increase. The most clear increase is in solar photovoltaics, basically doubling the last target. This is because we were already above the rates needed for the last target, so it makes sense to update this target. In wind capacity, we are a little behind the previous target, but still the target in this draft has been updated. For solar thermoelectric, the target was reduced. This is because there's been basically no new addition within the last year, so it makes sense to reduce a little bit the target because it was clearly impossible to reach that value. And storage is the other clear increase, nearly doubling, well, maybe 20-30% more. Because it's one of the things that were clearly missing in the previous plan. Also, important changes in biogases, so or renewable gases. Biogas from 20 billion cubic meters up to 35 billion cubic meters. That's a lot increase, and also important increase in the capacity for green hydrogen production, going from 4 to 11 gigawatts. Very important. Also, hydrogen was one of the clearly missing parts in the original plan, where they were basically saying nothing about hydrogen, just mentioning it as an alternative fuel. But as we think it's going to play a very critical role in the energy transition, it's good news that they've been included and they raised the targets. Other changes. This is comparing the previous PNEC with this draft. So increasing the reduction of greenhouse emission gases from 23 to 32%, as it was mandated by the European Union. One of the reasons of updating increasing the reduction of greenhouse emission gases, also increasing the renewable energy quota in electricity generation from 74 to 81%. So that's a lot of increase, 81% in 2030. Okay, also in renewable energies in final energy, increasing from 42 to 48%, reducing energy dependence from 61% to 51%, increasing renewable energies in transport sector from 15% to 25%, and increasing also a lot the annual growth of renewable energies in industry, putting a target of an annual growth of 5.1%. Also, gases and hydrogen in industry from 25% to 74%. So very, as you can see, very important changes. So anyway, what do we think? What are our conclusions after seeing this update? Okay, first, bear in mind that this is just a draft. The final document is expected for within 1 year. So there still can be changes, but we think that the most changes are already in place. So little changes can happen, but the large changes are already in place. We think that the goals are very ambitious, and this is what the plan needs to do. I mean, there's been the renewable energy sector has been pushing to increase the installed capacity targets, and we think that that's what needs to be done. Goals has to be very ambitious because there's a lot of potential renewable energy capacity in Spain. So it's important to increase the goals. But I mean, it's not a business plan. So it really is not more than getting to those targets. The most important is that we remove barriers, we encourage investments, we boost green energy demand in order to being able to integrate of this new renewable energy production. So at the end, market, it's the one that will be deciding how much new renewable capacity we will have. If we have very low prices, then very new projects. If we have higher prices, we will have more new productions, because then we will reduce, I mean, market is in equilibrium. So higher prices means less demand, more production, and the other way around. So at the end, the market will be deciding how much new energy or new demand is in the system. But it's important to have ambitious goals, because we have to have a clear roadmap. And then things that, well, we don't like, or that we think they are not a very good sign in this update. The electricity demand targets has been decreased, basically because the electricity demand has been decreasing this last year, basically because we had energy prices crisis. So higher prices means less demand. So the target has been reduced. That's bad news, because one thing that we think is that we need to incentivize the demand in order to be able to accommodate more and more renewable energy. So instead of reducing the targets because we have less demand now, we think it's important to incentivize and boost the demand and increase those targets, because as we know, less demand means more curtailments on renewable energy production, more price cannibalization. So with more demand, everything is better than with less demand. Also, international electricity connections. We know we are behind the targets of having 8 gigawatts of exchange capacity with France. The target has not changed, but and we are behind that. So it's difficult to get to those 8 gigawatts. But again, we think it's important and it's mandatory to have an increase in the exchange capacity, because if not, again, we will not be able to integrate all the demands, all the renewable energy productions, and again, curtailments, price cannibalization. So that's also a key point that clearly needs to be addressed and incentivized. Okay, and that's it. I will just take the opportunity to invite you to our next webinar. That's going to be in September. We are resting in August, so we will be back in September with our webinars, talking about PPAs, about electro-intensive consumers, large consumers of electricity, and how PPAs can benefit them. And also, we can also announce our webinar in October. As in the last 2 years or 3 years now, in October we will have Deloitte as invited to our webinar, talking about renewable energy projects, financing, and the importance of forecasting in portfolio evaluations, audits, due diligence, etc. So that's it. I'm just on time. So thank you, Alejandro.
Thank you very much, Oriol. Really great presentation, as most of your presentations are. And we will start now the Q&A section of this webinar. Since we are already almost out of time, we will answer only a few of the questions. Oriol, if you can select a couple of them, I will begin now with the first question. It is regarding the AleaSoft platform. I missed some of the Nord Pool markets. Do you have data of those markets? And the answer is yes. We already have the data for all of the markets of Nord Pool and for most European markets. And as Oriol mentioned, we are at all times including new markets in our platform, as well as new variables for the markets that we currently have. Oriol, if you can answer.
Yeah, a lot of interesting questions. I'll only be able to answer a couple of them, but we'll try to answer them by email afterwards, because there are a lot of very interesting questions about price forecasting in the next month, and what are the dynamics and implications and drivers of price forecasting. Very interesting also. So do you have forecast prices for green hydrogen? This is something that we have been requesting several times. So if you are interested in forecasting green hydrogen prices, just send an email to us and we can talk about that. We forecast any aspect that can be related to the energy sector. Green hydrogen is going to play a key role in the energy transitions. Another question is about our methodology. Are your electricity price forecasts based on time series analysis, or do you have any electricity market dispatch optimization model? Very good question. I can spend an hour talking about our methodology. Okay, our core methodology, it's a hybrid model based on statistical techniques that include time series analysis. It also includes regressions, econometric models, basically all kinds of statistical techniques, the basic statistical techniques, all of it combined with machine learning models and artificial intelligence and neural networks, recurrent neural networks, very useful when forecasting time series. So it's a hybrid model integrating classical statistical techniques with artificial intelligence techniques. And this is the core of the methodology, and it's the main, let's say, the main tool when forecasting at the very long term. But we also have more fundamental models, so describing or trying to simulate the market curve, so the demand curve and the production curve and how they intersect. We also have this kind of models, but we mainly use those for short-term forecasting. Short-term forecasting, we use a combination of these more fundamental models with our own technology of statistical models. But when talking about the long term, basically trying to simulate the market hour by hour, simulating the dispatch that you will have at every given hour for the next 30 years, it really makes it makes no sense. It's more meaningful to use statistical models when you can look at the annual level and see what's the behavior of the prices at the annual level. Then we can go down to the monthly level, weekly level, and finally to the hourly level. This is the core technology that we use, and is the one that is giving us the possibility also for providing probabilistic metrics, providing confidence band, Alea lows, that are those those values containing ranges of years with given probabilities. So yeah, the answer to the question is yes, we have time series analysis. We also have dispatch models, but we used it in different ways.
Thank you, Oriol. And as we are already run out of time, as Oriol mentioned, we will answer the remaining questions directly by email. And again, I invite you to our next webinar in September. And of course, the one in October with guest speakers from Deloitte. You can already register for those in our website. Thank you again, Oriol, for your presentation and the audience for joining. Have a nice day.
Thank you. Goodbye.